Hello everyone, welcome to BISP Solutions. So today we are going to see Accounting Standard Codification 260, that is, which stands for EPS, and Accounting Standard Codification 305, which stands for Cash Equivalents. So 260 and 305. So let's get started with Accounting Standard Codification 260, that is EPS. So EPS is nothing but earning per share. It addresses the standard the calculation, presentation and disclosure requirements for EPS by entities that either have issued common stock, that trades in public market or made a filing, or are in the process of filing. And it will also show you the presentation and disclosure. Here we'll see how to calculate the EPS, how we'll do the presentation and disclosure. So Accounting Standard Codification 260 requires entity to present basic and diluted EPS with equal prominence on the face of income statement for each period which is presented. And we'll see in the in the next upcoming sessions Accounting Standard Codification 270. So under Accounting Standard Codification 270, the same requirement applies to interim periods. So entities with multiple classes of common stock must present basic and diluted EPS for each class on the face of the income statement. Entities that report a discontinued operation must present basic and diluted EPS on the face of income statement for income or loss from continuing operations and the net income or loss. And the standard also requires entities to provide a number of disclosures about EPS. In some situations, entities must disclose pro forma EPS amounts as required by GAAP. Here we'll also see the topic or the different methods of calculation of the EPS. So an entity having a simple capital structure must present basic per share amount. Entities with complex capital structure they have to present basic and diluted per share amount. So EPS, so we have EPS bifurcated into two. That is, first you have basic EPS, then you have diluted EPS. So if we talk about basic EPS, this is required for companies with simple capital structure. If they don't have complex capital structure, they have to calculate the simple basic EPS and report it on the face of the income statement. They have to show simple capital structure. And in case of diluted EPS, it is required for the companies with complex capital structure. Who have complex capital structure, they have to follow the diluted EPS. And it is generally applicable on you can tell common stock holdings and other dilutive holdings like preferred stock, convertible debentures, options, warrants. So you can have here on other dilutive holdings. Okay, so for discontinued operations, any component or group of components of an entity that is on the verge of shutting down significantly affects the entity's operations or the conditions. Sometimes it is due to strategic shift. In such scenario, the company must present the discontinued operation section separately from the continuing operation section on the income statement. and entities must present the basic EPS, diluted if applicable per share amount. Now what is I have used the word simple capital structure and complex capital structure. So what are they? So simple capital structure is, it's an entity, suppose if an entity issues common stock and is said to have a simple capital structure, means if an entity that only issues the common stock, that company will be said to as that it is following simple capital structure. It does not have any convertible stock such as convertible preferred stock. If it has preferred stock that is non-convertible, such a company is said to have simple capital structure. This type of company will present the basic EPS. Now how we'll calculate the basic EPS? What's the formula of it? So basic EPS is equals to income available to common shareholders divided by weighted average number of shares outstanding. Okay, so this is the formula. Basic EPS is equals to income available to common shareholders divided by weighted average number of shares outstanding, where income available is, now here I am saying income available, so where the income available is, like you have dividend declared on non-cumulative preferred stock, or dividend that you have accumulated on cumulative preferred stock. So dividend declared on non-cumulative preferred stock means, if you have non-cumulative preferred stocks, dividend declared in that particular period need to be deducted to arrive at your income. So if you have income available means if you have non-cumulative preferred stock, so that the income, the dividend that you have declared will be subtracted from it to arrive at your income. Okay, and the dividend accumulated on cumulative preference stock is, if the preference stock is cumulative, then whether declared or paid, all the cumulative dividend for that particular period are only available to the preferred stock shareholders and not to the common stock shareholders. So that is the difference between if the dividend is declared on a non-cumulative preferred stock or if the dividend accumulated on non-cumulative preferred stock. So I repeat, if the dividend is declared on non-cumulative preferred stock, so if you have a non-cumulative preferred stock dividend declared in that particular period need to be deducted to arrive at your income. If the dividend accumulated on cumulative preferred stock, so earlier we were talking about non-cumulative preferred stock, and if the dividend is declared on cumulative preferred stock, so in this case the dividend will be deducted in that particular period. And in this case, if the preferred stock is cumulative, then whether the dividend is declared or it is paid, all the accumulated dividends for that particular period, they are only available to the preferred shareholders and not to the common shareholders. Okay, so then you will arrive at the income available. Now what is weighted average number of shares? So weighted average number of shares, you will calculate it by you have to say shares outstanding at the beginning of the period. At the beginning of the period, in this we'll add shares sold during the shares that are sold during the period, we'll subtract shares reacquired during the period, and we'll add stock dividend and stock split. So in this way you will reach till the weighted average number of shares. Now what is stock split and what is reverse stock split? So weighted average number of shares, they will be calculated on the time weight basis. So if your numerator, now here we are talking, if your numerator is increasing, that's a good sign. That means more income is distributed to the common shareholder. And if your denominator, that is weighted number of shares, it is increasing, that means you are adding more partners. So EPS getting diluted, so that is not a good sign. So ideal situation is the profitable situation is numerator is increasing and the denominator is decreasing. Okay, numerator increases and denominator decreases. So that's the ideal situation, a profitable situation. Okay, so this is your basic EPS. So EPS, it is one of the prominent financial ratios analyzed by the financial statement users. The objective of EPS is to ensure or to measure the performance of entity over a financial reporting period. It must be presented by the entities that have common stock that trades in public market, and second condition is it should file with a regulatory agency for the sale of common stock in a public market. And this standard will focus on the calculation, presentation and disclosure of the EPS. The basic EPS, as I told you, income available to stockholders divided by the outstanding common share. This is your basic EPS. Now, as I was saying, simple capital structure. So simple capital structure, like it's an entity that only issues common stock, and that will be said to have a simple capital structure. It does not have convertible stock such as convertible preferred stock. If it has preferred stock but that is non-convertible, such a company is said to have simple capital structure. This type of company will only present the basic EPS. Okay, so let's take one example. And complex capital structure is diluted EPS will be, in this diluted EPS will be followed. So diluted EPS formula, now see, now basic EPS we have seen here, basic EPS. Now we'll see the diluted EPS. So in this case, income is available to common stockholders or shareholders. We'll add here interest on diluted securities, and it will be divided by weighted average number of shares, number of outstanding shares or common shares. So this will be divided. So this is your formula. Diluted EPS is equals to, if that the same it is there, income available to common shareholders, you have to only add back the interest on diluted securities, and it will be divided by weighted average number of shares which is outstanding. Assuming here all the diluted securities, they are converted to common stock. If a company has convertible preferred stock, it must first convert them into common stock so that they can calculate the diluted earning per share, and adding more partners will lead to a dilution of the EPS. So what is called as complex capital structure? So entity is said to have complex capital structure when it has securities that can be converted into common stock. It also include convertible preferred stock, bonds, options, warrants, which can be converted into common stock. When a company has complex capital structure, it is necessary to report both basic and dilutive EPS. So if it has simple capital structure, it will have basic EPS. If it has complex, then it will have to issue basic and diluted both. If a converted, now there are different methods that needs to be followed. The one is your converted method. Second is the treasury stock method. Okay, so these two methods will be followed. So treasury stock method, suppose you have common stock. So there are two methods that needs to be followed under diluted EPS. So one is your treasury stock method. In this method, suppose you have common stock and you also have options and warrants dealing. To convert now options and warrants into common stock, we will follow the treasury stock method. In this method, the denominator changes. So as you exercise options and warrants, the company repurchases the treasury shares, resulting in incremental increase in the outstanding shares. Dilution only occurs when the average price is higher than your strike price. And then second is if converted method. In this method, when bonds and preferred stocks which are convertible to common stock, numerator gets added up. That is, income gets added by the interest expense portion that we have seen in diluted EPS formula. If numerator increases, it's a positive sign as the income is available to the common shareholder increases. When preferred shares are converted, the numerator increases as dividends no longer need to be paid to preferred stockholders. Now in if convertible methods, let's take one example. Suppose this is post conversion and this is actual, and here we'll consider the one is your income. Suppose income, it is actual, it is 1000, and post conversion will also be 1000. Second, it's a bond interest. So in actual your bond interest, it will be subtracted, so minus of 30, then you will get 970, that is your income after tax, income before taxes but after interest. Okay, then tax will be at the rate of suppose 20%. Then here 20% or 970 will be 194. Then you will get a differential balance of 776, that is your net income which is available to the common shareholders. And as per the, and in the post conversion, your bond interest will not be it will not be considered. Income before taxes will be 1000, 20% on it will be 200, and at the end you will get 800 as your net income available to the shareholders. So this is your final amount and this is your final amount. So now if you want to say this is your income available to the common shareholders, if you add back the interest, that is this 30 is your bond interest and this is before tax. On it if you charge the tax, that is 20% on 30 will be 6, so 24 will be added back over here, income available to shareholders, because that is also after tax. So 20 will be also here, 24 will also be after tax, and you will divide it by the number of share outstanding. Then you will get diluted EPS. Okay, in this way you need to do the calculations. Okay, now we'll start with the second accounting standard, that is 305, which is issued by FASB, that is Financial Accounting Standard Board. It provides a framework for defining and reporting cash and cash equivalents in the financial statement. So now we are talking about Accounting Standard Codification 305. So it provides the implementation guidance on cash on deposit at financial institution. So assets which are displayed on the statement of financial position, they are the resources available to the reporting entity to support its current and future operations. Preparers, they should bear in mind that an investment does not mean Accounting Standard Codification 230 defining of cash equivalent unless the security is purchased very near its stated maturity date. So cash is the most liquid of assets, and cash items are generally classified as current assets. Here we'll talk about concepts, rules, examples of cash and cash equivalents. Cash whose use is restricted would not be included with cash unless the restriction on it expire within the year or the operating cycle. So what all things we'll be seeing over here in cash and cash equivalents? There will be two. First we'll see what is cash and cash equivalents. Second, we'll be looking at examples. Third is the classification of cash. Okay. So now what is cash and cash equivalents? So cash and cash equivalents means now cash include your currency and demand deposits, both with either financial institutions and with banks. Cash equivalents also include short-term, highly liquid investments that are readably or readily convertible into cash, that can be easily converted into cash. That is your short-term investments, short-term liquid investments you can call it. These should have a maturity for 90 days or less from the date of purchase. And this Accounting Standard Codification 10 here overall provides guidance on cash on deposits at bank and financial institutions. The guidance will apply to all the entities and have no scope exceptions. Now cash and cash equivalents examples we can consider as, if we talk about considered, and secondly we say not considered. So if it is cash and cash equivalents considered, so you can say like coins, currency on hand, saving account, check, money market, then you can say negotiable paper, then certificate of deposit. These are all examples of your cash and cash equivalents which are considered. Not considered means certificate of deposit with original maturity over 90 days. This is within 90 days, okay? And time certificate of deposit. These are not considered, so this is not a part of your cash and cash equivalents. Time certificate of deposits. And the next you have certificate of deposits. With maturity over 90 days. Now, if you want to see what is compensating balance. So compensating balance means here, if you are saying what is compensating balance, it is if it is legally restricted or not legally restricted. So compensating balances can help you identify your cash and non-cash items. They are also not legally restricted and are considered as cash. They are legally restricted and they are not considered as cash. So cash you can again I said now cash you can get the bifurcation as under two. One is your restricted cash. and you can say it is unrestricted cash. Restricted cash means some restrictions are put, you cannot use it readily, but here unrestricted cash means you can use it readily, it is available. And restricted cash means like some dollar is there, you need to have some conversion, and this is the money, your cash. Now restricted cash means it can only be used for a specific purpose. This can be used for a specific purpose. And unrestricted cash, if we talk about, this can be used for all the operations. And restricted cash is a current asset if it is associated with your current asset, current liability, and unrestricted cash is a non-current asset if it is associated with the non-current asset and non-current liabilities. Now let's see an example of how to calculate your cash balance. Suppose a 30,000 check which is payable to supplier and drawn on Blue's account, it was dated and recorded on 31st December but was not mailed until 20th of January. So it was recorded on 31st but was not mailed. So what you will say, it will be included under the cash balance or not? And second condition is 1000 check payable to Blue Limited dated 3rd January. It was not included in the 31st December checkbook. So if it was not included in that checkbook, will it be considered your cash balance or not? A 2000 check payable to Blue Limited deposited on 20th December and included in the 31st December checkbook balance. It was returned as a non-sufficient funds. This check was redeposited on 3rd January and was cleared on 8th January. Now we need to find out, we need to do the calculation of your cash balance. So you see, unadjusted balance of Blue Corp ledger account as on 31st December was 2 lakh. This was the balance. Then a 30,000 check was payable to the supplier and drawn on the Blue's account. It was dated and recorded on 31st December. So this will become a part of your cash balance because on 31st December this become a part of it. So add check payable to the supplier. Then a 10,000 check payable to Blue Limited it was paid in the next year, that is Jan. We are recording till 31st December if you remember, because the balance was given of till 31st December 1993. And this check was it was payable to Blue Limited, which is dated on the next year, that is January 3rd, and it was not included in December 31st. So we'll not include this 10,000 in this current year, we'll include it in the next year. 20,000 check payable to Blue, it was deposited on 20th December and included in December 31st checkbook balance. It was returned as a non-sufficient funds, means we issued to Blue on 20th of December and it was included in 31st December. It was returned as non-sufficient funds. The check was deposited again, or that is redeposited on 3rd of Jan and was cleared on 8th of January. That means in the next year we again redeposited it and it got cleared on January 8th. So whether it should be included in the cash balance under till 31st December, so yes, so initial check date we'll consider. So initial check date was 20th December. So less, here we'll reduce the non-sufficient funds, that is of 20,000. Okay, so here adjusted balance will be, because we are paying it. Okay, so adjusted balance will be we'll add 30,000 because we have received the check, we are paying the check to somebody, so we'll reduce the funds, so it will 2,10,000. So this is how you need to calculate your cash balance. You know now what is cash and cash equivalents, what is considered as a part of your cash and cash equivalents, what is considered as a part of cash and cash equivalent, what are not considered, and what is restricted cash, what is unrestricted cash. Okay, and what is it example. Then EPS also we have seen, what is diluted EPS, what is basic EPS, when basic EPS will be applied, when diluted EPS will be applied, what is a true scenario of profitability situation, how we calculate the income available, we have seen this, how we calculate the weighted average number of shares, this is the criteria. If it is diluted EPS, we'll add back the interest on diluted security, we saw this. So this is all about today. We have covered these two, that is 260 and 305. accounting standard codification. Yeah, so thank you all for your time. If you have any questions, please contact BISP Solutions. Thank you.